one of the challenges about an LBO model that gets this complex is it's very important to kind of take a step back and see what's driving what. That said, of course, if you're comfortable with everything that we've done, then you don't need to listen to this video. This is just going to be a wrap up, kind of walking everyone through a 30,000 foot view of all the moving parts in this model. If you're comfortable, just move on to the next section. So I'm going to zoom out a little bit. Hopefully you guys can still see this. And I'm going to sort of split the screen. And on the bottom of the screen, I'm going to look at that summary tab that we built a few videos ago, which really kind of crystallizes what the returns are to all the providers of capital. This summary tab right here. Let's try to make this a little bit bigger. So at a 7.3 times exit EBITDA multiple, these are all the providers of capital and what their returns look like. I think it's going to be very useful. Let me make this just a tad easier to see. So what I think is going to make this very useful is to just kind of play with numbers so you see what's driving these summaries. So for example, if I'm selected approach number 1 and I increase the multiple that I have to sort of buy this company out at, you would expect that the IRRs would go down for anybody participating in the equity of the business. And that's exactly what you see. The reason for that is if you go to the sources and uses of funds now, in order to get this deal done, you have to buy out more equity. You have to spend more to buy out the equity. And given a fixed amount of leverage, you have to pony up more capital yourself. Given that the exit multiple assumption has stayed the same, you're just getting less at the end, but putting in more in the beginning. That's obviously going to squeeze your returns. Now, of course, if your exit multiple changes along with it, your returns go up. Not as much though. It's interesting to note, by the way, that if you get in at 8.5, if you get in at 8.5 and you get out at 8.5, that's not as good as getting in at 7.3 and getting out at 7.3. And the reason is getting in at 7.3 means you have to put in far less. And so the way that leverage works, this is sort of the magic of leverage at work. The larger the piece of the pie coming in from everybody else. So at 7.3, getting in and at 7.3 and getting out at 7.3, it's a 90% debt financed deal. Getting in at 8.5 and getting out at 8.5 is only a 75% debt finance deal. So you're not getting the benefit of leverage to the extent that you did when you could buy for so little. All right, so it's very interesting dynamics to kind of play with in the model. Let's bring the exit back to 7.3, and let's bring this to 7.3. Okay. So a couple of other things that I want to show you in terms of what's driving the model. Obviously, as you would expect, the higher the fees, you'd have marginal sort of reductions in the IRR. Leverage, we know, is the biggie. We've already built data tables to kind of play with that. For example, if you bring this down, if you weren't able to take on a subordinated note, if this is 0, the real deal was more like this, right? So the real deal looked more like this, and there was no sub or preferred. And if you weren't able to secure a bond, for example, if there's no appetite in the public markets for a bond, your returns go down significantly. Why? Because you have to pony up that cash, presumably, as long as the banks won't kick in the extra money that you need. So obviously leverage makes a big difference. We've already talked about the important role that your projections play in determining what your IRR might be. You can make any deal look attractive if you make the operating forecast attractive enough. And this is why in all of our classes, we baked in scenarios into operating scenarios into the deal. We haven't really baked them in here yet. I feel like you guys have gotten such a good handle on scenarios in our other courses that we're sort of delaying that sort of added feature into a later video. But those of you who have gone through any of our courses know that it's pretty straightforward to add scenarios into this. So instead of these operating assumptions, you get something, you can put in anything you want by having scenarios somewhere in your model. So we'll do that in a subsequent video. So operating metrics really drive your model as well. And then, in terms of some of the other big drivers in the model, really what's interesting And this is sort of a typical feature in a lot of models, and you have to be kind of cognizant of it. If you recall that the way that we forecast all these long-lived assets, we determined depreciation, amortization, all of these line items, we forecast them based on what the, sort of the best practices for, hey, what is it as a percentage of CapEx and things of that nature. And then we linked it directly, all of those we linked back to the EBITDA schedule, right? We just added all of them up. Now understand that EBITDA is so absolutely critical to determining what your exit valuation is going to be, to determining what your cash flows are going to be, because your cash flow statement adds back D&A. This is a big part of what your cash flows look like. That you really want to make sure that these figures are sort of consistent with what management is guiding to. Fortunately, we checked and they were consistent. They did provide some D&A projections and we were generally in line. But one of the things that you should be absolutely aware of in your model, and one of the things that tends to trip up folks that are dealing with models like this, is understanding that we start with EBIT in our model and then we add back D&A from these schedules to get to EBITDA. Well, what that must mean is that implicitly, this D&A is buried in cost of sales, R&D, and SG&A, though we never really specifically added in here. It's not like we ever sort of bifurcated gross profit excluding depreciation and amortization and then the depreciation and amortization component. We never bifurcated R&D separately from D&A that's baked into R&D, or SG&A separately from D&A that's baked into SG&A. So there is this issue where, if all else equal, if I'm going to say that my depreciation and amortization here is really high, and I haven't changed my assumptions here, I'm actually implicitly saying that my other operating expenses are declining a little bit. That's usually not what you're trying to say. So you just have to be very careful that your D&A forecasts are in line with what management is guiding to, or that you understand that if you're going to forecast a higher than expected D&A figure, that you make sure that your operating forecasts are consistent. Otherwise, you're run in danger of really overstating EBITDA or understating your operating expenses. So it's just something to be careful about. And let's kind of move down this list and look at sort of debt. We talked about debt and its importance in sort of driving the model. One other thing that you can actually play with, and this is something that folks will play with, is, hey, how do these discretionary decisions about what I do with my excess cash, how do they affect my returns? For example, what if I don't use any of my available cash to pay down debt? What's going to happen to my returns? Well, as it turns out, in this particular case, nothing. Because all of that cash is just getting accrued towards the, and is going to get just added back to my equity value because I have all that excess cash sitting on my balance sheet. So these decisions could potentially be made if, for example, you have opportunities where you want to conserve cash and so you'd rather not pay up debt, or the debt has a very high cost of capital, so you want to necessarily, so that you want to use it. But you see here, it's not really moving the needle too much. It's just a little bit. You actually have to expand the decimal places to actually see it. It goes from if you use up 100% of your excess cash to pay down the term loan A, you go from 33.4% to 32.8%. Not even really enough to significantly move the needle. It's not always going to be the case, but that's certainly the case here. Okay, let's bring this back. Interesting. What it does do is it does change the IRRs a little bit to the term loan A. So if term loan A, doesn't, unfortunately, from the lender's perspective, they typically don't want you to prepay because you can see that it's actually prepayment reduces their IRRs. They're in the business of keeping money out there, generating interest for them. If you prepay, that IRR dips down. So you can see that the prepayment has an impact on IRR, not just to the equity folks, but to the providers of capital. Similarly, if you have higher mandatory paydown schedules, you're also going to see a reduction in IRRs. So kind of going down this list here, let's bring the summary tab back into view. Going down the list, obviously interest rates are going to make a difference. If you negotiate a higher coupon rate, that's going to reduce IRRs. And if you negotiate higher spreads, that's going to, lower IRRs, that's going to lead to lower IRRs as well. You see the IRRs going down. And the bigger, the bigger this is a piece of the capital structure, the more the impact there's going to be on IRRs. So that's just what I wanted you guys to be aware of. Some of this may be obvious, some of this may not be obvious, but these are the key drivers of a model. Obviously, if I have equity kickers, that's going to lower my return. So all of this may be a little redundant, but I thought it was important to kind of just go over that. All right, so that brings us to the end of the course. Congratulations, you've built a full-blown LBO model for a real company. And as always, we pulled no punches. This is an investment banking grade model. Hopefully you found this challenging but manageable. Of course, as with all things in financial modeling, there are a few things we didn't cover. I just want to walk through those briefly because I think it's important to know what the goal of this was as opposed to what I think constitutes some advanced LBO modeling. So I didn't think it was appropriate to get into the dynamics and interplay between general partners and limited partners at a PE firm, for example, or how PE firms structure their funds and kind of the what's called a PE waterfall, where you sort of look at, okay, when we start a fund, how the general partners make out versus the limited partners. That's sort of a little bit outside the scope. I focused squarely on the analysis of the transactions that PE firms undertake, namely LBO transactions. Notice also that we didn't build a full balance sheet. So actually looking at this deal, the BMC deal, notice we didn't actually build out a full balance sheet that balances, like the financial statement modeling course that most of you who are listening to this course have taken. There's a reason for that. We only forecast the balance sheet items in an LBO model that we need to determine returns to investors. That's ultimately the goal. Remember, the bottom line in this model is, what are the returns to investors? What is the offer price at which returns and hurdle rates make sense, right? So that's the focus, and so that informs how deeply we get into certain things. And interestingly enough, we didn't build a full balance sheet. As a result of that, though, we bypassed some M&A accounting. We were able to get away with ignoring some M&A accounting issues that create modeling challenges, like the creation of goodwill and the accounting of write-ups, the fact that you have to write up certain assets that emerge when you build an LBO. Those, again, who have gone through our M&A course are quite familiar with that. When you buy, when there's an acquisition taking place, and certainly the BMC deal was an acquisition by a private equity firm of BMC, that merits the write-up and the creation of pro forma financials that have certain accounting implications. We ignored those. We were able to ignore those because it didn't matter. Of course, if you're curious about things like that, as well as several other things that, again, I think sort of qualify as advanced LBO topics, like modeling PIK toggles, deferred taxes, nuances between accounting rules for what's structured for tax purposes as an LBO versus a recapitalization. Definitely, we offer an advanced LBO modeling course which takes this exact BMC LBO model and it layers some of those issues on top of that. So definitely worth a look for those that want to get really deep into some advanced LBO concepts. With that, congratulations again, and thank you for taking this course.